Okay, let's go over an example of capital budgeting. So we have the following project. So the project requires an initial investment of $7,500 at time zero. That's our capital expenditure, our capex. The project will increase overall sales by $9,000 every year. Overall variable cost of goods sold by $5,400 every year, and by an overall fixed cost, so we call them, they may not be necessarily fixed, but selling, general and administrative expenses do not necessarily vary with the quantity of the new product sold. So they are kind of fixed. They're not absolutely fixed because a new project will increase them. But if the new project sells 1,000 units instead of 800, so SGA will not be affected, but cost of goods sold will be affected. So cost of goods sold is the time spent, okay, assembling a bicycle, okay, and all the single parts of the bicycle. This is the cost of preparing the bicycle and putting it on the shelf to be sold. Selling, general and administrative expenses are advertising costs, okay, or some managerial costs that do not depend on whether 55 bicycles are sold or 2,000 bicycles are sold. Okay, they're somewhat fixed given the number of given all the different products the firm is producing and selling. The project will last 4 years. At the end of year 4, the equipment purchased at time zero will be sold for $500. That's the salvage value. Additions to net working capital in a given year is equal to 8% of the increase in sales. The CCA rate is 45%. And the asset class to which the assets purchased in period 2 to which belong, okay, the assets purchased in period 0 will continue after the sale of the assets at time 4. This is a technicality. It means, so when the assets are sold for $500, I mean, depreciation continues because $500, as we have seen earlier, is smaller than the remaining undepreciated capital cost. But even if the sales price was higher, so if the assets were sold for like $2,000 at time 4, that would create a negative CCA expense. So CCA expense, we will not even be able to collect on other assets of the same class. Will be incurred by the firm. Why? Because the asset class continues. So this is not the unique asset in the asset class. So the asset class includes other assets the firm already owns. Tax rate is 40%, and the appropriate discount rate for the free cash flow calculation is 12%. Okay, so here's the timeline. Sales at time 0, so minus $7,500 in capex. So free cash flow for year 0, $7,500. Year 1, $9,000 of extra sales, $5,400 of extra costs, which means an increase in gross profit of $3,600. We subtract the $400 in selling, general and administrative expenses minus the CCA depreciation we computed earlier with a capital expenditure of $7,500 with a tax rate of 45% and so on. Initial investment, $7,500. The project will increase sales of $9,000 every year over the next 4 years. It will also increase variable costs, so the cost of goods sold, over the next 4 years. Setting general and administrative expenses will go up by $400. CCA is the CCA we have calculated previously with the CCA rate of 45%. So depreciation is a non-cash expense. We subtract it to compute EBIT so that we apply the tax rate to earnings after depreciation. But then we add back the CCA depreciation because in fact all it does here is it allows us to pay less taxes because it allows us to report a smaller earnings before interest and taxes. We need to add it back because if we don't add it back, it's as if we were calculating the cost of $7,500 twice. So here minus 1,688 minus 2,616 and so on. So the sum of all these numbers here will amount to $7,500 into perpetuity. So we subtract it here to reduce the tax expense. Okay, to have a tax expense which is closer to what the firm will actually pay. Then we add it back in the cash flow calculation because it's a non-cash expense. Now, we take earnings before interest and taxes. We apply the tax rate to it, and this gives us a tax expense. So $1,512 times 40% is equal to $605. 584 times 40% is equal to 234, and so on. So here we collect depreciation on the continuing asset class. So even though the project is over, so because we have other assets in the same class as these assets here, depreciation continues. So depreciation continues forever. So here, for this specific project, once it's over, it still saves us taxes. Okay, so we have no sales from this specific project, but we have other sales. We have no costs from this specific project, but we have other costs. But we still continue to use depreciation from these assets. And these depreciation and this depreciation expense allows us to save taxes. So it's a positive cash inflow of $84. Plus, at the end completely, we recover net working capital. So there are significant cash flows past year 4. UNI is unlevered net income. So net income is income after taxes. Unlevered means, so we apply taxes to earnings before interest and taxes. So we apply taxes on the earnings before we subtract interest. This is why we call it the unlevered tax income. Additions to net working capital. Note that the timing of additions to net working capital is always one period after capital expenditures. So we start the project, we need to buy the assets at time 0 so that we produce an income at time 1. But the additions to net working capital take place at the same time as sales increase. And so they increase at time 1 and they decrease at time 5. So at time 1, sales, the change in sales is $9,000. So 8% times $9,000 gives $720. So this is more net working capital that has to be placed into the firm's balance sheet. Now when the project is over, so sales, overall sales decrease by $9,000, which means we recover 8% of $9,000 in terms of net working capital. So here we recover $720. So from year 4 to 5, additions to net, so the cash flow consequence of the additions to net working capital is positive. And in year 4, we also collect $500 by selling the assets purchased at time 0. The present value of the stream of free cash flows generated by this project is then given by $7,500 minus plus 1,875 discounted over 1 year plus 2,966 discounted over 2 years plus 2,495 discounted over 3 years, and so on. So we obtain a net present value of $500. Okay, now the previous calculation only takes into account the tax impact of the CCA over 5 years, even though we have seen earlier that the CCA implications of the assets purchased at time 0 continue into perpetuity, because it produces 3 perpetuities. So one perpetuity using the first half of the capital expenditure beginning in year 1, a second perpetuity using the second half of the capital expenditure beginning in year 2, and a third portion of CCA implication coming from the sale of the assets at the end of the project. So suppose we compute the net present value of the project by using the full present value of the CCA tax shield. This means for all the free cash flow in every year where sales are increased because of the new project, we will remove depreciation. And instead, we will compute the value of depreciation as of time 0 using this formula here. So in our example, the full present value of the CCA tax shield is $2,141. So we can, the easiest way I find to calculate it is to calculate it using all 3 portions, okay, of the CCA calculation. So here, I mean, the first one, it's a perpetuity, which is the decrease in value of 1/2 of the capital expenditure at the rate of 45% multiplied by the tax rate. And the last, so the second one is the same as the first one but discounted over 1 more period. And the last one is the non-depreciating value of what has been collected when selling the assets. And it has to be discounted over the number of years, okay, which are consistent with the time at which the assets are sold. So if the assets are sold at time 4, so this perpetuity is discounted over 4 years. If the assets are sold at time 5, so the value of this perpetuity here is discounted over 5 years. And the third tranche of the CCA tax shield is a negative number. Now, instead of considering earnings before interest and taxes, because we do not subtract CCA depreciation in years 1, 2, 3, 4, 5. So what we compute here is EBITDA, earnings before interest, taxes, depreciation, and amortization. So this number here is constant, because what was changing in the previous calculation was the CCA depreciation. So here everything else is constant. Sales are constant, cost of goods sold are constant, SGA is constant, so EBITDA is constant. So taxes are constant, and EBITDA after taxes is also constant. The net present value of this project here will be slightly higher So by taking into account the full present value of the CCA tax shield, we obtain a net present value of 556 instead of 510. So the net present value we obtain is $46 more than what we obtained by using only like a fraction of the true CCA tax shield. We will see why in the next video.